Paul Tudor Jones is here. He's the founder and chief investment officer of Tudor Investment Corporation. Of course, he is also the founder of the Robinhood Foundation, which is hosting its annual investor conference in partnership with JP Morgan that's going to begin tomorrow, and we're thrilled to have you on the program.
So good to see you again.
We got to talk about a lot of things because we are now 14 days away from the election, and I think everyone is trying to make sense of this market and where things are headed and where things are going. So where are we?
For me and in the hedge fund world, this is the macro Super Bowl coming up on November 5th. And I think this one, some elections are not that binary. This one is binary, not so much because of which candidate wins, but it's binary in the sense that what is the market's response going to be to either candidate if they win? And so we can either continue down the path we've been on, which I'm going to frame here in a second, or we may have that point of recognition where all of a sudden the markets have different ideas than what the candidates have been espousing.
Before you lay out where you think that piece of it is, let me just ask you this. So Stan Druckenmiller said that he's convinced by market indicators right now that Trump will win. And I'm curious if you agree with that thesis. Part of it is that he's looking at it in the betting markets. Part of it is he's looking at the shares of DGT. Part of it he's looking at Bitcoin.
Certainly the markets are saying he's going to win. I think they're heavily skewed by Republicans, so I don't know if I necessarily believe the betting markets, but I don't have any great insights. I really don't. I just would be more skeptical of them than I would normally. It's the same way, look, in football betting, right? You can get a huge home bias where the line doesn't reflect realities. Yeah, I know what they're saying, and I respect them.
But what about other investors? Dan Loeb recently came out with a report to his investors saying that he's positioning or repositioning his portfolio around the thesis that former President Trump will become the president.
And I have also, if I'm being honest, primarily because I see the polling numbers have clearly moved in this direction.
You say also, meaning you've repositioned as if former President Trump wins.
Yes, I've moved in that direction, for sure.
And what does that mean?
It just means more inflation trades, which I'd love to get to, but right. I think it's really important that we frame where we are right now. And where we are is an incredible moment in U.S. history. And what I really want to talk about is the debt trajectory that we're on. We've gone in the space of 25 short years from debt to GDP at the federal level from about 40% to almost 100%. And if you look at what our trajectory, what CBO projects our trajectory to be, as well as what we see, we're going to project further than CBO. So I'm going to show you a chart. This is debt to GDP. So CBO says that we go from 98 to 122, 124. That's very conservative over the next 10 years. If you extrapolate that 30 years, you get to 200% debt to GDP, and something that can't go on forever, won't. And the question is, after this election, will there be some point of recognition, particularly with all the tax cuts that are being promised by both sides and the spending plans? They're handing out tax cuts like they're Mardi Gras beads, right? We're doing tax cuts on everything from tips to toucans. So it's crazy what's being promised. After the election, I think the fact that you've got 7 to 8% budget deficits as far as the eye can see, the question is, will the markets allow either candidate? I think under Trump, the deficit goes up by $500 billion per year. Under Harris's plan, it goes up by an additional $600 billion per year. I think the chances of any of those being enacted are zero. I think the markets will, the debt markets for sure. The Treasury market won't tolerate it. It's so funny because financial crises percolate for years, but they blow up in weeks. That's the history of them, right? And for me, this election becomes one of those seminal points where all of a sudden, let me really think whether this proposition that the U.S. government is making me is something that I actually want to participate in. Let's assume that I'm making $100,000 a year. You've lent me, because we're such great friends, $700,000. Mm-hmm. And I come to you and say, okay, Andrew, I'm going to pay all that back to you in 30 years. But between now and when I ultimately pay you back, I want to borrow $40,000 every year for the next 30 years. And then at the end of 30 years, I'm going to pay the whole thing back. Would you lend me that money?
Unlikely.
Okay, so that's actually the proposition that the U.S. government makes to every bondholder today. That's the exact same proposition. So think about this. We owe $35 trillion. Our tax take is $5 trillion. So we owe 7 times what our tax take will be this year. Our revenues will be this year. And our deficit is $2 trillion, and it's $2 trillion right now as far as the eye can see. That is literally the proposition that the U.S. government is making to someone who buys a 30-year bond.
So the question is, life is relative, so some people would say, sure, you can either buy bonds from the U.S. or you could buy bonds from some other country that has an even worse situation.
Or you cannot buy bonds.
At all.
So anyway, I was watching this Vince McMahon documentary, and in it, I loved wrestling, particularly when Stone Cold and The Rock and all of them. So in it, there's a term that I'd never heard of called kayfabe. And in wrestling parlance, that represents the unspoken, unwritten, tacit agreement between the wrestlers and the fans about the illusion that's going on in the ring, the suspension of disbelief that what's going on in the ring is actually, we know it's scripted and we know it's a performance, but they ask us to think it's genuine and real.
And so that's what you think this is?
Yeah, we're in an economic kayfabe right now. And it's not just the United States, we're in it in the UK, in France, Greece, Italy, Japan being the biggest of all. It's this economic kayfabe. And the question is, after this election, will we have a Minsky moment here in the United States in U.S. debt markets? Will we have a Minsky moment where all of a sudden there's a point of recognition that what's going to happen or what they're talking about is actually fiscally impossible, financially impossible?
So are you betting on a Minsky moment?
I am clearly not going to own any fixed income, and I'm going to be short the back end of fixed income because it's just completely the wrong price.
Let's talk about taxes, though.
Okay.
Because that's how the money is going to get raised, one way or the other.
Correct.
I think we have a screen, if we could, that puts up a little bit of a menu here.
Yes.
Of, I don't know if it's options. Actually, they may not be options.
No, there are plenty of options.
So the question is, of what's on the screen, you can let the tax cuts expire.
Look, can I just say this? You have to let the tax cuts expire. That's $390 billion. We're going to be broke really quickly unless we get serious about dealing with our spending issues. 60% of our spending are transfer payments.
If you think we're going broke, and you think Trump is going to be the president, he's not going to let those tax cuts expire if he can avoid it. He does not want the corporate tax rate to go to 25%, as you're suggesting it'll have to. He's suggesting it should go to 15%.
I'm saying that just to get us to the point where we stabilize debt to GDP at where it is right now, here's what you need to do. You need to let the Trump tax cuts expire. That's $390 billion. You need to raise the payroll tax on every single working person, 1%.
Then you want to increase the individual tax rate all the way to the top rate of close to 50%.
No. What I'm telling you is that we've got to be serious about where we are fiscally. And so I'm giving you, there's a whole set of options, right? We could go in and cut 25% of the federal workforce. Some people may do that. There's a website where you can go look and play with all the options. You can raise the capital gains rate from 21 to 28%. That only gets you $10 billion a year. It actually doesn't get you what you need. So I'm simply showing some of the things that you can do. Yes, you'd have to raise the tax rate on the top, I think probably everyone over 200 grand, probably have to raise that to 49.5%. If you do all these things, raise the Social Security from 65 to 70. If you do all these things, means test, Medicare, if you do all these things, all you do is you get to a primary balance. What that means is you stabilize debt to GDP. You're still actually increasing your debt. You're still actually increasing it because it excludes the interest cost, which, oh, by the way, the interest bill this year is larger than every single line item except Social Security. It's larger than defense spending, larger than Medicare.
I want to talk about why you're here, which is Robinhood and this conference. But before I do that, is this, given all of the things you're saying, are you off buying gold and Bitcoin and
I think
somewhere?
all roads lead to inflation.
Does all roads lead to inflation? Therefore, gold is a good investment. Is Bitcoin a good investment to you?
I'm long gold. I'm long Bitcoin. I think commodities are so ridiculously underowned. So I'm long commodities. I think most young people find their inflation hedges via the NASDAQ. That's also been great. It's probably some combination. I probably have some basket of gold, Bitcoin, commodities, and NASDAQ, something like that. And I would own zero fixed income. If I had my cash, it'd be very short term. The playbook to get out of this, you see it in Japan right now. They have 2% inflation, 30 basis points overnight. They don't want to raise rates. The playbook to get out of this is that you inflate your way out and you have a small tax on the consumer and you run interest rates and nominal growth rate below inflation and nominal growth above inflation. And that's how you reduce your debt to GDP. Given where our debt to GDP right now, every 100 basis points is worth about $90 billion a year to the deficit. So yes, if we're trying to stabilize debt to GDP, we want to run the most dovish monetary policy that we can without letting inflation become too much of a tax on the citizenry. So yes, all roads lead to inflation. That's historically the way every civilization has gotten out, is they've inflated away their debts.